What are the trends in IPOs? IPOs come and go. People can invest in companies that are publicly traded for the first time ever. Should you do so? What kind of movement are you expecting on that first day? What about the second day? Does it matter if the prior weeks were positive or negative? How about whether or not the company lists at the higher end of their range? All these factors are critical to know what happens to the IPO price on listing and in the first few weeks of trading. Let's get right into that right now. First off, an IPO is an initial public offering. It's when a company takes a sleeve of its privately owned shares and lists them on an exchange. They're offered publicly and they're traded in the market for the first time ever. The process actually involves raising capital, typically through an institutional investor. So they might say, we want to raise another billion or $500 million. And that is done before the IPO raise from an institutional investor, kind of as a bonus or as a carrot for that company to come in. Remember that the investment bankers or the investment banks or a group of them will do what's called book building. They're going to call their big clients and say, how many shares would you want of X company and what price would you be willing to pay? And then the big clients answer, the investment bank, they build their book and they say to the underwriter, we would likely take 500,000 shares at that price. And all the companies do this, and that gives an idea or an indication to the company as to how much appetite there is for their company. The next day, the listing opens up trading on that stock, and then anyone can buy and sell that stock. And remember that on that first trade in the morning on IPO day, it typically runs like an auction. The bid and the ask will come in, they'll match it, and all of the shares will be done at that particular price. Now let's talk about IPO Pop. How much does a stock typically pop on the first day? Over the last 15 years, the average has been right around 16%. So an average IPO will pop on its first day 16% and will finish 16% higher than where it opened. Now, in times where markets are hot or the IPO market is hot, that number is going to be way higher. According to data from Jay Ritter, IPO pops in the last 45 years are about 18.4%. This means that a stock closes 18.4% higher than the IPO price, or anyone who invested in it can exit at day's end making an 18% profit. Not bad for one day's work. The problem is getting access to these IPOs. They're often tightly held. Often only the best clients of the largest investment banks get any allocation to these stocks. And oftentimes if you want to participate, you have to buy it in the open market, just like everyone else. Now in some years, those returns are going to be a lot better than others. 2020, that number was 38%, but prior to the tech bubble, that number was 60%. So if the market's frothy for IPOs and there's a ton of appetite, you might be making 40, 50, 60%. But in typical markets, you should expect to make somewhere around 15 to 18% on that IPO pop on your first day. You might ask yourself, why is the promoter or the underwriter mispricing these securities that much? Why would they misprice it by 18% on the first day? Don't they have a feeling or an idea for what the price should be? And the answer is obviously they do, but they want to leave some meat on the bone. They want to leave some profits on the table for anyone who's coming to the market, giving capital for shares of a company that's not yet trading. When they're pricing their IPO, they think they have a pretty good idea of what the price should be, and they always go a little bit lower than that so that there's a ton of appetite for the stock. Obviously, this is a very difficult game, and this is something my dad used to do as an investment banker. He used to price IPOs. And when you're pricing IPOs, you have to consider a lot of things. How much appetite is there? How sexy is the stock right now? How hot has the market been lately? What about the sector? And then you have to say, okay, we think we can get X, let's price it a little bit lower than that. And oftentimes, they're a little too conservative. What you don't want to happen is you price your IPO too aggressively and then nobody wants your stock. And then you have to reprice it, or worse yet, you have to pull the IPO. That would be a disaster for a company. Remember that when you're pricing an IPO, part of that reason that the IPO pops so much is the liquidity premium. You used to have a private company, now you have a publicly traded company. So now there's a premium paid for liquidity. My dad used to always say the liquidity premium is at least 20%. You get 20% more for the same company if it trades on an exchange or if it doesn't. If it trades on an exchange, you could buy and sell, you get your money out today. You get a premium for that, and that premium should be 20%. How many IPOs fall on their first day? 31% of IPOs fall on their first day. That's a significant number. That means about a third of the time, the investment bankers are actually mispricing the IPO, or for whatever reason, the IPO falls flat on day one. What are some other factors that can influence the outcome of an IPO price? One of them is float size. Float size is the percentage of the company that the IPOing company is choosing to put out there or to sell. Now, typically this number will be anywhere around 10 to 30%. 40 years ago, the IPO float used to be a lot larger. They used to put out 30% of their company, even 40% of their company as a float to start the trading of your stock. You don't put up all your stock to trade, you only put up a portion of it to create liquidity for those who want to sell their securities. Recently, we've seen a trend where the float size is diminishing, and the average has been about 20%, but we've seen some IPOs in the last year or two as low as 10% of the float. There appears to be data that shows that the smaller the float size, the more likely the IPO is going to be positive on day one, and the higher the pop is likely to be. More bounce in the IPO on day one. One of the best indicators as to whether or not the IPO will pop is at what end of the range the IPO gets set. If the IPO gets set at the high end of the forecasted range, as you can imagine, the IPO is sexy, there's a lot of appetite, and it will likely pop once the market opens and once the stock starts trading. Data shows that if prices are filed above the range, you end up getting 64% for large cap, 53% for mid caps, and 25% pop for small caps on the first day of trading. If it's done within range, you're looking at anywhere from 10 to 33%. And if the IPO is filed below the range, now you're looking at a 2% pop on open. First off, mega cap companies, and second off, you want them above the range that's been given to the regulators. What about the market conditions? Does it matter if you're IPOing in a rising market or in a flat market or a down market? Turns out your instinct on this is right. If you're IPOing when the prior 3 weeks were positive, you're much more likely to get a pop on the first day. For example, when the market was down in the prior weeks before the IPO, companies perform a lot worse than when the market was up. If the market's down 2.5%, you can expect to make anywhere from 10 to 32% on your IPO pop. But if the market was up 2.5%, now you're making 11 to 51%. One thing that's of note here is that the larger cap IPOs, the bigger the company is, typically will perform a lot better than smaller companies. The IPO pop is typically a lot larger when the value of the company is higher. What about the sector? Does the sector matter when it comes to IPO performance on day one? You guessed it, tech stocks perform a lot better than non-tech stocks, with tech stocks generating 32% return on that first day and non-tech stocks generating only 11% return on that first day. Do earnings matter when it comes to this? Companies that are not profitable have performed better on their first day of IPO than companies that are profitable, if you could believe that. Companies that are profitable have averaged around 13% on first day, and companies that are not profitable, about 26% on that first day. You're probably asking, what do I need to know about day one? What do I need to know about day two? And what do I need to know about owning this stock in an IPO? So clearly, there's market inefficiencies when pricing an IPO. Even the best investment bankers on the planet, it's a bit of a crapshoot for them. They're trying the best they can to price these IPOs tightly to where the company's going to get as much capital as possible, and yet the investor's going to make a little bit of money for participating in the deal. But it's a tough game. It's a tough game because about a third of them, they're pricing inaccurately, and a whole whack of them, they're pricing way too low. Even with all the information they have at their disposal, IPO pricing is a tough game. If you're asking whether or not you should participate in these IPOs, the one piece of advice I would give you is only participate in these IPOs if you want to own the stock for the long term. Don't try to trade these. They're incredibly volatile. Although we think we know how they're going to perform on day one, we actually never do, and IPOs always surprise us. There's no real rhyme or reason to the trading pattern that happens on day one, day two, and day three of IPOs, and it is incredibly dangerous, especially when we see a whole whack of IPOs fall on day two of trading. Be careful out there. Stick to your plan, stick to your logic, and remove emotion from the process. If you'd like to book an obligation consultation to chat about how IPOs can fit into your investment portfolio, go to speakToRob.com. We'd love to book that and chat with you about that. Thanks for tuning in, guys. Have a great day. I'll see you in the next video.